Hey everyone, welcome back to Corporate Decoder, the place where we unpack the confusing world of corporate filings and make it actually interesting. Today we're looking at Humacyte, Incorporated's latest report, and let's just say this one has a bit of a twist. So this form is called an 8K, which basically means it is reporting a significant event that shareholders should know about. Think of it like a company breaking news alert. The earliest thing this report talks about happened on the 21st of November, 2025. This is for Humacyte Incorporated, the company we've talked about before. They're working on something pretty innovative with regenerative medicine, aiming to create artificial organs. It is a field with huge potential, but also serious challenges. Now, a lot of this filing is about the nuts and bolts of how their company is structured and registered with the SEC, the Securities and Exchange Commission. They're registered on the Nasdaq stock market under the ticker symbol HUMA. They also have these things called warrants, which are basically options to buy shares of their stock at a specific price. These are traded under the ticker HUMA, and this filing confirms Humacyte is an emerging growth company. This means they get some leeway with certain reporting rules, which is common for newer companies trying to get established. Okay, so here is the big news, the main point of this filing. It is about the termination of a material definitive agreement. Material definitive agreement sounds super fancy, but it just means a really important contract. Back in September 2022, Humacyte made a deal with an investment bank called Jefferies. This deal, called an open market sale agreement, basically allowed Humacyte to sell up to $80 million worth of its stock through Jefferies over time. Think of Jefferies as a broker who helps the company sell its shares to investors in the public market when it wants or needs to raise more money. But now, on the 21st of November 2025, Humacyte sent a notice to Jefferies ending that agreement. This termination won't happen immediately. It will take effect about 10 days later. The good news here is that Humacyte doesn't have to pay any penalties for ending this contract. This is a pretty common practice, as these agreements often have clauses allowing either party to end them with sufficient notice without facing huge fines. So what does this mean? Why would Humacyte end an agreement that lets them raise money by selling stock? Well, it could mean a few things. Perhaps Humacyte feels they no longer need this specific way of raising capital. Maybe they have enough cash on hand for their immediate needs, or they are pursuing a different, perhaps more attractive financing route. It could also signal that they believe their stock price is poised to rise significantly, making a future sale at a higher valuation more appealing than continuing with this agreement at current or projected prices. Or it might suggest a shift in their strategic outlook and capital needs. For a company in the complex and capital-intensive biotech space, managing cash is everything. Ending this agreement is a clear signal about their current financial strategy and confidence in their future prospects. This is signed off by Dale A. Sander, who holds some pretty important titles: Chief Financial Officer, Chief Corporate Development Officer, and Treasurer. That means he is the top financial person and deeply involved in how the company grows and manages its money. His signature on this indicates the company is formally making these changes. Looking at Humacyte as a whole, they are engaged in a very high-stakes game. Developing regenerative medicine and artificial organs is incredibly innovative, but it is also extremely expensive and carries high risk. The success of such ventures relies heavily on continuous funding for research, development, clinical trials. And eventual manufacturing agreements like the one they just terminated are often crucial for early-stage companies that need to tap into public markets to fund their operations and growth. The decision to terminate this sale agreement is therefore a quite significant one. It suggests a level of confidence internally that the company either has sufficient funds or has other plans for securing capital. It is a move that could be interpreted positively, implying improved financial health or a more promising funding outlook. However, it also removes a potential safety net for raising quick cash if unexpected financial needs arise. Investors will be watching closely to see how Humacyte manages its finances going forward, especially without this readily available source of funds. What is next for Humacyte? Continued progress in their research and clinical trials will be key. Any significant breakthroughs or positive trial results could bolster investor confidence and potentially lead to better financing opportunities in the future. Conversely, any setbacks could put pressure on their financial runway, making this termination of the sale agreement a more critical decision in hindsight. The company's ability to navigate the complex regulatory landscape and successfully bring its innovative products to market will ultimately determine its long-term success. So, there you have it, a simple announcement in an 8K report that hints at a bigger story about Humacyte's financial strategy and its confidence in its own future. It is a reminder that even for innovative companies, managing money and having a clear financial plan is just as important as the groundbreaking science itself. Alright, that is our breakdown of Humacyte's latest filing. What is your take on this decision to end their stock sale agreement? Do you see it as a sign of strength or a potential risk? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord community linked in the description below to keep the conversation going. Thanks for watching, see you next time.